Morning, everybody. It's the 31st of January, finally. Feels like January's been going on forever. Welcome back, Steve. I'm Joe, obviously joined by Steve this week, back from his holidays, and we're both talking ball this morning. How you doing, Steve?
Yes. Yeah, not bad, mate. Looking forward to talking ball.
Good.
Lots going on in the markets since I've been away, so I'll do a little bit of jigging about on my charts while you talk about FX and see if I can sort of see where we expect to be going now. But yeah, it seems
All right, well, don't stress too much. We can cover it between us, I'm sure.
yeah,
Give you a bit of time to settle back in.
yeah, but it seems like the same old story in the indices. While I was away, I saw there was a couple of days of decent sell-offs, and they sort of evaporate.
By the dip.
Yeah, doesn't no change there then.
No.
So yeah,
All
we
right, well, shall I get stuck into some headlines then? You can have a
yeah,
play around with your charts, then we'll go into the FX market. So, in terms of the latest news, Goldman Sachs expects the Bank of England to raise rates at least 3 times this year, a move that will mark the quickest tightening in a quarter of a century. The firm's economists also joined Wall Street peers in forecasting that the Federal Reserve will raise rates more aggressively than previously expected, now predicting the Fed will lift its near zero benchmark by 25 basis points 5 times this year rather than on 4 occasions, and that would take the benchmark to between 1.25 to 1.5% by the end of the year. Russia further boosted troop levels on the Ukrainian border this week, despite them saying they're not going to invade. That's according to the Pentagon. Russia has denied it intends to invade after massing tens of thousands of troops plus tanks and equipment near Ukraine's eastern borders. US lawmakers are close to finalising the language for a Russia sanctions bill, while the UK is looking for ways to target oligarchs' wealth held in the London property market. It's a busy week for European politics. Boris Johnson will this week introduce a Brexit freedom bill and hold talks with the Russian President Vladimir Putin, an attempt to pivot away from the Partygate scandal, which he tends to do. He just hides it with more scandals. That tends to be his style. Um, Spotify outlined its steps that it will take to halt the spread of misleading information about COVID-19 on its audio streaming services in an attempt to quell a growing controversy over its support for podcast host Joe Rogan. I don't know if you've seen anything about that, Steve. Um, Not
no,
massive
I haven't
news, of
seen
course.
anything. I mean, I like him. I follow him quite a lot. So what's going on there?
There's a few, I think, I don't know, he may have said some anti-COVID stuff or whatever, or vaccine or whatever, and there's a few musicians now who are requesting to be taken off of Spotify unless he gets taken off. And I
Oh
think
wow,
they opted to keep Joe Rogan instead of these other artists.
exactly. Yeah, there's some musicians. So like big musicians or
There was quite a couple of high-profile older singers rather than sort of more modern day
yeah,
stuff.
they may as well get rid of them. There's like loads of new kids on the block.
They
What's the
just turn
point?
their music into an NFT or something.
Yeah, exactly. Yeah. Wow. Just sort of like people think they can just, I don't know. People are thinking above their station.
Yeah,
Get rid
well,
of
it's
them
gone
or
mad.
I'm leaving you.
Yeah. Okay, so markets look set to be starting the week on a positive footing as things stand. Another impressive late session rebound on the Euro stocks on Friday, Steve alluded to a moment ago. We have the Lunar New Year holiday starting in Asia this week, so that's causing markets to thin out a little bit. So we're expecting to see a little bit less action on some of the indices, particularly in the Asia Pacific region. In terms of earnings, that's obviously still underway. And tomorrow we have Amazon and also ExxonMobil. So a couple of biggies coming out this week. So I'll get stuck into some charts now and let's take a look at FX to start with. So this is the dollar index. Still bullish on the outlook here, trading within this bullish channel. We saw a nice break above 96.94 last week, a really impulsive move higher on the 27th. We then posted a doji in the following session, and we're seeing a little bit of a pullback to potentially retest this newly formed support at 96.94. So providing that holds, it could provide the base for a continuation higher up to our next resistance, which is at 97.72. That's the 61.8% Fibonacci retracement of this entire move here from the highs that we saw at the height of the pandemic down to the lows we posted in January last year. So that should prove to be a bit of a big resistance level, really, I think. But then above that, we're starting to look for moved up to the 78.6, which is around about the 100 level on the dollar index, which I think is very doable this year. So let's take a look next at Euro US dollar. As you would expect, on the flip side of what we've just seen on the dollar index, we are seeing weakness here. So again, we've got this big head and shoulders top pattern that played out, broke down in August last year, continued to see prices move lower within a downtrend. We saw a bit of a consolidation here, followed by a break to the downside, and that also saw the swing lows from the November lows taken out. Impulsive move lower on the 27th, and today we're seeing a bit of a retest of that newly formed resistance at 111.86. So still looking for lower prices there, maybe an opportunity to sell into this minor rally that we've posted today, looking to target somewhere between these levels here at 110.58 and 110.04, which is our target level on the downside. Onto cable. Bit of a bounce back in this today, posted a bit of a doji on Friday, but overall still trading in a downtrend and still expecting to see lower prices here. So continued dollar strength is the main driver rather than that being weaker sterling at the moment. Take a look at euro sterling. That was close to 23-month lows on Friday. As you can see, it's been 4 consecutive days of negative price action. We are up so far by 0.06%, so very mildly higher, but still looking for lower prices here, down to this 82.75 level. The reason being, that's the previous lows that we've got here from December 2019. So that seems to be a decent level to be trying to target on the downside. Doesn't look to be any let up on this at the moment, so still expecting to see the sellers dominate this for now. Taking a look at some of the riskier plays linked to commodities. So starting off with Aussie US dollar. Following the breakout of the consolidation channel here, prices have continued to sink to the downside. We actually made a new low on Friday at 69.67, and that is the lowest price that we've seen since July 2020. So getting close, or maybe we already have completed a large head and shoulders top pattern here on Aussie. And by taking out this low from the 2nd of December, it looks like we have the potential to continue moving lower towards this 50% fib level at 67.56. So this is the lows that we saw around the height of the pandemic to the highs that we posted in February. That 50% level looks to be a pretty reasonable area to target over the short to medium term. Bouncing back a bit today, but could be short-lived. It is engulfing the losses that we made on Friday, actually. So we'll see if there's any legs in this and if it can hold on to that into the close at 10 o'clock UK time tonight. New Zealand dollar, US dollar, that continues to sink lower. That's actually getting very close now to the 50% fib level at 64.70. Broken through this downtrend channel and sinking ever lower, it would seem. Although this is another candidate for maybe posting an engulfing candle. Got a little bit more to do. It's up by 0.6% today. I think my preference would probably be to sell into rallies there, expecting that to fail, if I'm honest. So that'll do on the currency side of things. Steve, do you want me to take over any asset classes, or are you quite happy looking?
Yeah, no, I'll just give a brief overview of what I can see now. Obviously, I'll do a little bit of work on these today and then maybe have a bit more information tomorrow. But just really looking at a slightly longer term picture on what we've seen over the last, month, really, which is quite interesting. I'll start with cryptocurrencies. Obviously, I've been pretty bearish on cryptos for a good while now, to a lot of people's disappointment. But I continue to be in that vein. Bitcoin, for me, still has a lot further to go on the downside. We have to test 28,800 now after the sort of like the really decent break we've got of the $40,000 level. We're in a bit of a correction at the moment. It looks to have topped out around about 39,000, and further downside I think we're going to see this week. If we look at the weekly chart, is this head and shoulders formation that I've talked about. Again, it's not it would have been, you get a head and shoulders formation at the top of a rally. They're the ones you really look for, which played out really nicely here. This one has had a rally from 28,800. The measured move target of this, though, you measure the head to the neckline. Once it breaks the neckline after the right shoulder's formed, which it has done, the neckline came in at 43,000. The measured move target is targeting somewhere to look towards 15,500. We've also got this rather decent support level around about 20,000, which was the all-time high for a while back in December 2017. So there should be support down here. I think the 28,800 is a level which we've visited of quite a few times. We've got a band of support between 28,800 and 30, just over 32,000. So that is the support level which we stalled in front of. We posted a bullish hammer on the weekly chart, so that's a little bit of a positive note. And if we look at the MACD, the moving average conversion divergence, that is negative, and potentially another dip lower would extend this negativity. So I think Bitcoin's still on the back foot on the daily chart. You've got the sort of trend is moving lower. You've got the Ichimoku cloud resistance. I think all the way up to 44,000 will be decent resistance. It'll struggle to get above that. I won't dive into the other indices unless someone asks me to. So sorry, the other cryptos. Looking at, I don't want to look at the weekly chart. I want to look at the monthly chart on the indices. FTSE's really performed well this month. We saw the bullish engulfing candle from last month, and we've pushed higher. Still further upside potentially there. Obviously, that's got bank stocks doing well with interest rates going up, and also the energy markets potentially doing well with the price, oil prices moving higher, and the issues that we've got with Russia going on at the moment, which is squeezing prices higher. So that's good for the components of the FTSE. However, not so good is a lot of the other indices. DAX has sort of like topped out at 16,300, and a bit of a bearish candle there. But the real bearish candles I'm looking at are in the US markets. This we've got what we've got today. Is it last day today for January?
Month, yeah.
Yeah. So
It's the 565th day of January today.
oh wow,
that's what it feels like since we last got paid.
Yeah, yes, it does. Yeah, it's a long old month, isn't it? So 34,500 really. If we can close below there today, then that will be a bearish outside candle. That would be very negative for, in my eyes, for the Dow. Obviously, we've got the positive momentum is stalling and looking for a MACD crossover support coming in around about the 33,289. So. But yeah, this one, the Nasdaq one on the monthly chart, that's pretty horrendous looking. Take out the price here. Yeah, we got the shooting star candle, this hanging man candle maybe, and this really bearish, really strong move lower. Got down to 13,700 last week, in fact, and we can see the moving average crossover divergence going down here. I mean, this only sort of like goes back to 2009, this chart, so it doesn't go back very long, but this is obviously the move which is in dire need of a correction. Similar type of candle, very negative candle on S&Ps, which obviously got down to that support around about the 4,270, traded just below there, 4,227, before reacting higher over the last week. So you know, we got short-term positivity, but on the month this is a pretty horrendous looking. We saw this probably back in February 2020, which then we got the sort of the pandemic hit, and we saw extended moves lower. So this is just the start, I think, of a sort of like a short-term bear market on the indices. And the one that I always
just while you was on that, Steve, I was talking last week about the potential of being a head and shoulders on the S&P.
Okay.
Don't know if you want to zoom into the daily and give it your thoughts. Very early call, obviously. So where you've got that downtrend starting, that's your sort of left shoulder. Then you've got the big head. Maybe this is the start of the neck, or forming the neckline for a bounce now into a right shoulder.
Yeah, and yeah, it's sort of like if basically potentially all the way up to 4,550, which is easily achievable in the indices in the first few days of the week even. So we can easily get that coming up and you'd get some sort of, I mean, let's just take the low from there. That sort of.
It looks a bit too perfect, though, is my only concern.
Yeah, but why not?
Obviously,
There's
it's highly speculative at this point because it's not head and shoulders until it completes. But
yeah, and it's still sort of like you've got this resistance that it's got to go into. Yeah, potentially. Why not? It's long way off absolute forming, as you said. We could even sort of like look down here as the 4,228. But this sort of correction that we're having isn't a huge correction in the grand scheme of things.
no.
You've sort of seen this massive rally that we've got here from the lows of 2020. Not exact. Forgive my not exactness, but even a 38.2% retracement would take us down to 3,800, and that would that's a normal correction, but it would feel like the end of the
Measured move of
world,
the
I
head and
think.
shoulders.
Huh?
Measured move of the potential head and shoulders. Where would that be?
Yeah. Yeah, I
Oh
mean that's
yeah.
sort of like down to there, isn't it? So that just tells you it's sort of like it could feel like a real big panic mode and people selling out and the end of the world, but it's just a normal correction. So although I did say it looks like a bit of a bear market, it's not a bear market, it's just a correction. So I'll rephrase how
So
I said that.
10% is a correction, 20% is a bear market, right?
Yeah,
According
and
to classic definitions.
also you just sort of like think about GDP as well from a sort of like a more of a fundamental perspective. I think was it how many quarters?
That's a recession, isn't it?
Yeah, recession, but it's sort of like they'll go hand in hand with a reversal. I mean, it just feels like we're going to get a correction. Feels like depression at the moment, doesn't it? Especially after this 578 day January.
Days of January, yeah.
The market that really I've harped on about, and I can't find the sort of like the piece that I read. Basically indicates that China 50 is the one that's going to lead the market this way. And I've been talking about this 14,500 area for a long time. We had the last spike higher in December. We got up to 16,763, but then this aggressive move low really has been aggressive, where China's sort of like stalling. A break of 14,500 would be very negative. Let me just let the dogs out.
Dogs are happy, aren't they?
Yeah, they are. Yeah, so I sort of like this is really key. If it doesn't hold on here, then this could be the catalyst that drops it lower. Obviously, Russia may have a part to play in being a catalyst as well, depending on what they get up to and how the rest of the world respond. So it's pretty scary stuff in the indices, and I think a lot more volatility to come over the next couple of months. So hopefully we'll give you some sort of like decent levels to trade off and to look for. On the commodity side of things, the oil, I wanted to really take a look at the oil. My long-term charts, I've been saying for a while, we're fifth and final wave, and then a correction, but I'm changed my mind now. I sort of think we could be basically, we could have just had the third wave, something like that, and now we're looking for the fifth wave. So these sort of levels around about the $100 mark, people are talking about $100 oil. No reason why it can't go there. This would play out. This will be, we've had the third wave. Now the third wave is normally the longest wave. It's very rarely the shortest wave. So if the fifth wave is equivalent to the third wave or less, 115 is the sort of like the target area on that. So I think now we've broken or taken out the October highs, that it really opens up the upside. And I think we saw it in natural gas as well. The recovery that we've had, the monthly chart posting a bullish engulfing candle, very positive after we saw that breakdown and the gap down last month in December, early December. We saw that gap lower consolidation. Support came in at 350. That support has held. We posted a lower, a sort of higher low, and then we've sort of had 6-7 days of real positive price action. We had a gap open this morning. Expect to fill that gap before we continue higher. So yeah, natural gas seems to have sort of like bitten back quite nicely. On the gold side of things, we saw a little bit of a pullback after we saw a lot of price action around about the 1834 level. That was taken out, and we have posted a lower high. So I think this gold has got a bit further downside. It's traded quite nicely off that high that's been posted at 1855. Bounced off this trend line, 1780 or just in front of it. So really a break of 1780 is the one to look for extended downside on that. In the meantime, there is obviously potential for a little bit of pullback higher. So yeah, that's about that on the other markets.
Lovely. Thanks for that roundup, Steve. And of course, welcome back. Okay, so gun to the head while you've been away. What have I managed to achieve? Let's have a look. Feels like forever. Okay, so since you went away, I'm up basically 0.7R, let's say.
Okay.
So a bit of a mixed bag. A couple of decent wins in there, but a couple of losses on the bounce, which have sort of brought me back in line with pretty much where I was before you went away. So let's see if our combined efforts can see us push on a bit further. I guess you don't really much of a chance to have a look at anything, so let me see if I can dive into something now and find a trade idea. I'm going to do this trade idea because I've actually set this one up as a personal trade, so it's pretty much close to where I wanted to get. I haven't actually been filled on this yet, but I wanted to sell Aussie CAD into its resistance at 89.78, but it's currently at 89.75. So I'm going to take that entry instead. Stop loss in the same place, 90.06, targeting 89.07. So just looking for 2.1R on that one. It would be 2.5R if I managed to get filled at my desired level. So that's my trade of the day, selling Aussie CAD. Did that give you enough time, Steve? Apologies if it didn't.
No, yeah, it's probably. I think I'm going to struggle today to actually, capture the market. It feels like we could be a little bit of positivity on the indices, but for me, it's selling into this strength is probably the way to go. I'll just pick a DAX to start off with. There's a decent level above of resistance that if we get above 15,600, basically, I would say is it's probably the wrong trade idea. So let me put that one in very quickly. Yeah, getting short here, 15,546. Stop 100 points higher at 15,646. And let me go for a 4-to-1 risk reward, which would take us down to this support level down here, 15,146. That's my trade idea for the day.
Love it. Good luck, Steve. Okay, so data-wise today, we've got at 10 a.m. UK time, Eurozone GDP, the Q4 number. The quarter-on-quarter rate is expected to fall 0.3%, and the year-on-year is expected to fall to 2.9%. At 1 p.m. today, we also have German inflation numbers. Prices expected to rise 5.1% year-on-year and 0.6% month-on-month. And then at 2:45 UK time, we have the US Chicago PMI index number that's expected to fall to 62.5. So 3 high impact data points due out today. As we said, we are expecting a bit of a quieter week this week because of the lunar holidays in Asia. We've also got results out from Amazon tomorrow and ExxonMobil. So that is that for today, Steve. Last day of the trading month and first day back for Steve in 2 weeks.
Yeah, nice. Yeah, I enjoyed it as well.
Good. All right, well, we'll be back tomorrow with some more. And until then, trade safe, everybody.
Cheers, everyone.